Yeah, well, a combination of factors. Seasonality matters, but I think macroeconomic data is the key one now because there's lots of data dependency. I mean, given the Fed is placing a lot of emphasis on data, but clearly what we've seen over the last 2 weeks is that even every single piece of data scrutinized by market to determine the direction of the economy. So data is becoming much, much more important. Even those tier 2 data is now becoming much, much more crucial.
Yeah, a lot of it has been pretty surprising, right? I mean, forget about that July miss on the payrolls and that 4.3 unemployment. There's also, we've been talking about this, right? The big, huge revision down in the Bureau of Labor Statistics numbers, payrolls for the year through March. Most folks are going, look, A, it's sort of backward-looking, it's historical, right? And B, it does not account for massive immigration into the U.S. as well.
Yeah, well, I think what's important is we have seen, yes, the jobs data on July, but clearly if you look at retail sales, if you look at the economic activity, especially initial jobless claims, because these data, insurance claims is real money that's being paid out. So those data is still pointing a fairly strong labor market. It's slowing down, it's cooling, but it's not cracking. So I think from that perspective, there's some comfort in markets, but clearly the next jobs report is going to be very crucial.
So 25 or 50 in September, Powell's not going to give us any clues, really?
Yeah, no, I think he will kind of leave it open for to give him some leeway to make that decision. I think we are penciling about 25 basis points, but I think clearly now markets are divided 50-50 between 50 and 25.
James, what then are you telling clients about how they should approach the rate-sensitive sectors in the markets, whether it's in the US, where you have the strongest equity overweight and conviction, and if we are heading into more chop, especially in and around the US election in early November, then do we need to take out more of a defensive policy, and what should diversification as well look like?
Yeah, well, we think it's going to be very much like a barbell. On one end, you want to look for income, and that comes from investment-grade bonds. And I think it's still a good time to get into investment grades, deploy cash into investment grade. I think that would work as a kind of a diversifier. And recently, we've seen the correlation between bonds and equities becoming negative again. So that means that there is a role as a diversifier for bonds. But I think it's very important to be invested still in the US market because we've seen how resilient it was over the course of this year. It has pulled back over the last 2 weeks, but now it's recovered back, almost reaching its all-time high again. So there must be an allocation, a strong allocation to US markets. And I think that barbell approach of having invested in equity markets, primarily in the US, as well as investment grade, I think it's quite crucial for investors to kind of go into this choppy period of investing.